Sir, there is one doubt. Is the manufacturer of nil rated goods required to get himself registered?
It's a very good question again. See, under excise and customs, together, let me make it for customs also. Nil rated goods and fully exempted goods. Get me a pen, marker pen. Nil rated goods and fully exempted goods. What is the status of these two varieties under excise and customs? See, as far as excise is concerned, these are excisable. No matter what would be the rate. See, excisability and dutiability are two different entities. Don't mix up. It is like mixing up alcohol with driving. So, excisability simply means something is available there in the Tariff Act. Something is sitting there. It is available in Tariff Act means it is automatically excisable. And maybe rate of duty column, maybe it is nil or it may be 10% or 12%. That is about dutiability. Liability part. Accessibility and liability you have to look apart. You have to take apart and you have to look them separately. So, nil rated goods are there in the Tariff Act. Because they are there in the Tariff Act, they are excisable. Number one. Number two, nil rate is also a rate of duty as far as excise and customs are concerned. Today it is nil, tomorrow it will be full. It is subject to change. So, conceptually, nil rate is also a rate of duty, even though the tax liability, ultimate tax liability is nil. In the case of exempted goods also, what happens? There is a levy at a particular tariff rate specified in the Tariff Act, but government under section 5A of excise or section 25 of customs granted exemption, maybe full exemption. So government has offset the liability. Government has simply waived the liability, but there was a levy. So these fully exempted goods are also chargeable goods. So nil rated goods and fully exempted goods are excisable goods, and they could be chargeable also. They are chargeable also because there is some rate, because nil rate is also a rate. Under customs, nil rated goods are dutiable goods. Dutiable means chargeable goods. Understand? So when you are manufacturing nil rated goods, when you come to registration part, if you look at registration rule 9, read with the notification given by CBEC, notification number 36/2001. You have to read all these things carefully. If you read, no registration is necessary if you are manufacturing absolutely exempted goods. Absolutely exempted means fully exempted goods. Number one, if you are manufacturing nil rated goods, no requirement. And if you are a small scale industry up to 1.5 crore turnover, you don't need registration. So registration is a different issue. Registration is a different issue. Registration is not required. But certainly you are manufacturing accessible goods. Remember this. Today or tomorrow, anytime, your nil rate may become a full rate. Then you have to get ready. Done? So from registration point of view, it is not required. But as far as technicalities are concerned, both are accessible, both are chargeable.
So there is one more query related to this only. Can the place of removal and place of delivery be same?
It is a very interesting question, but this is relating to valuation, section 4 valuation. So it has come from a particular student. It's a very good question. Congratulations. So you have to go a little deep into this. Place of removal and place of delivery, they should be same. If you look at the valuation scheme under section 4, it contemplates section 4(1)(a) says place of removal and place of delivery must coincide. They must be one and the same. Then you can apply the transaction value directly. Otherwise, if the place of removal and place of delivery happen to be two different places, then You have to apply rules, particularly rule 5 becomes relevant. And let me tell you, place of removal, place of delivery are two entities. If you look at this, two different, and you have to look at them from two different angles. Say for example, place of removal is like origin. It is origin. Place of delivery is the destination. So just like say Gangotri is the place of origin for Ganga, and Bay of Bengal is the place of delivery, that is destination. So, but it so happens in excise you have manufactured goods and you are giving delivery at your factory gate. So their place of removal and place of delivery are same. So section 4 is applicable, direct. Take the price and apply transaction value directly. No modifications necessary, so no rules are required. No application of rules. Whereas your place of removal is factory, sale took place at the factory, but you are giving delivery at the customer's place, and ownership has already transferred at your factory gate. But if the price happens to be inclusive of transportation cost, you deduct those expenses from the door delivery price. Say you are in Delhi and your customer is in Kanpur, you are giving delivery at Kanpur, but the price includes the door delivery price, the transport and insurance up to the premises of Kanpur, right? So in such a case, rule 5 allows you to deduct transport and insurance charges full, both the fare charges, going and coming back. There is a circular, you read carefully the circular, and based on Gujarat carbons, Gujarat floor mills, I think Gujarat floor mills case, there was a circular in 2010 going to the customer's place and also coming back. Both the fares are deductible. So total price minus transportation expenses from place of removal to the place of delivery, they are deductible. But if the title passes at the place of the customer, this is more technical, you should be very careful, students, but such a situation doesn't happen. If the title passes, means if the ownership happens to pass on to the customer at the place of customer, means place of removal and place of delivery are customer's place, that is Kanpur. So transportation charges are not deductible. You should be very careful. You understand this? Say rule 5 is applicable where sale took place at the factory gate, ownership transferred at the factory gate, and the only thing is the price is inclusive of transportation charges, because the point of sale is factory, whatever expenses incurred after the sale are deductible. Suppose the sale takes place at the premises of the customer, nothing is deductible, everything is includable. See, in excise, what they followed, what the government is following is point of sale principle. You have to check up where the sale took place. Suppose the sale took place at the factory, and whatever expenses incurred after the sale, they are deductible if they are already included in the price, right? So point of sale, if the point of sale happens to be branch and all expenses up to the branch are includable. If the point of sale happens to be the place of customer, all expenses up to the place of customer are includable. If the point of sale happens to be warehouse, all expenses up to the warehouse are includable. If the point of sale happens to be factory, all expenses up to the factory only, and whatever is beyond, that is not to be considered. So you should be very careful. Valuation topic is very technical. So anyway, good question. I think
so I hope
understand this.
This doubt is clarified that both the places could be same and different valuation rules are applied for it.